Finally, the last thing we're going to discuss is LA Gear's liquidity. Recall, up top, we identified that we might have some liquidity concerns because of the very low levels of cash and the poor cash flow margins. So let's go ahead and take a look and evaluate some of those ratios. So let's go to our ratio tab and let's look at some of those liquidity ratios. First, our current ratio. It's gone from $1.46 in current assets for every dollar in current liabilities up to $2.14. So our current ratio has actually increased, which is a good thing, so that's better. But notice we're still what? Overall, our current ratio as measured, liquidity as measured by the current ratio is still worse than the industry average. So we're still worse. We found, or can find, that one of the reasons for the big increase in our current ratio, recall, was the rapid buildup in inventory. We had a big buildup of inventory. And when inventory goes up, that's a current asset, so our current ratio we would expect to increase. But our acid test, or quick ratio, excludes our inventory. And our acid test ratio went from 0.7 to 1.12, which again, it increased, which means we are doing better. But nonetheless, we are still what? Significantly below the industry average. So we are worse than the industry average. Next things I would look at would be our cash flow liquidity and cash flow margin. These were really bad, which of course we would expect. Cash flow liquidity, remember, was a combination of how much cash we had on hand, which was very little cash plus our operating cash flows, and our operating cash flows were negative. So we had a negative cash flow liquidity, and we also had a negative cash flow margin. Now, our cash flow liquidity, I guess it increased. It got a little less negative, which is better to the extent we could say it's better, but we are still in awful shape and far worse than the industry average. The same thing with our cash flow margin. It was costing us $1.06 in cash to generate $1 sales in year 2. Now it's only $1.04. So yeah, I guess our cash flow margin has increased in that it's less negative, and that's better, but we are still far worse than the industry average. We are losing cash on every dollar we sell. Our cash flow conversion cycle, day sales in cash, that's the next one we'll look at. Day sales in cash went from 6.8 days down to 1.33. That was good from an efficiency or asset turnover perspective, but the decreasing cash flow or day sales in cash signals we have very little cash on hand, and we are certainly much worse than the industry average. And again, we can see that looking at our balance sheet. Recall that sales tripled, but our cash actually went down. And we need a certain amount of cash on hand to sustain our business. Finally, cash flow conversion cycle. It went from 247 days to 148 days. That's a decrease, and that's good news. We're cycling our cash faster, but we are still significantly worse than the industry average. Our operating cash flows were, what happened to our operating cash flows? I guess they didn't change very much at all. Not much change. And compared to the industry, we don't have an industry comparison, but I know the industry cash flows have to be positive because they have a positive cash flow margin. So we are definitely worse than the industry. We're definitely weak. Overall assessment of liquidity, I would say maybe not much change and weak, or perhaps not much change, or maybe I guess we did have a little bit of improvement. We were better across a lot of those ratios, but we're still definitely have a weak liquidity position. And for your written liquidity analysis, I want an overall assessment. and in this case it was despite improving current and quick ratios, we still have some serious liquidity problems. We had dangerously low levels of cash on hand and negative operating cash flows for the past few years, and we're using our short-term line of credit to help fund our operations. And then I've got some numbers in here, numbers on our current ratio, our day sales in cash, okay, and then also a discussion of our operating cash flows.